back to the Tax Studio sessions. In today's episode, we're going to be diving into an area that's essential for anyone looking to manage their finances wisely: tax planning strategies. Especially with the recent changes that we've seen in the budget, using tax planning strategies is one of the most powerful ways to maximize your earnings, prepare for the future, and to avoid surprises at tax time. Whether you're employed, self-employed, or a business owner, there are strategies that you can use to legally minimize your tax bill. Grab a notepad. We're going to be covering everything from deductions to credits to long-term planning techniques. So let's get started. How can you maximize your allowable deductions and credits? One of the most straightforward ways to reduce your tax bill is to take full advantage of these deductions and credits that are available. But there's often a difference between what's allowable and what's missed. For employed individuals, uniform and professional fees are a great expense that you can claim back. If your job requires specific uniforms or professional memberships, you may qualify for a tax deduction. If you've been working from home, there may be an allowance for utilities, internet, and home costs that you can also claim. For those of you who are self-employed or who are freelancers, you can claim home office deductions. Ensure that you measure the square footage of your office space and compare it to your home's total area to get a proportion for utilities, mortgage, or rent. You can also claim supplies and utilities. Office supplies, new technology for work, and even software subscriptions for your business are all great deductions that you can claim. If you're a business owner and you provide certain benefits to your employees, such as pensions or health insurance, sometimes you can deduct these from your taxable income. If your business also buys significant equipment or machinery, you can benefit from claiming capital allowances to offset against the profit. One of the changes that we saw in the budget was the annual investment allowance of up to £1 million. This can be a great tool to use to minimise your tax bill by claiming capital allowances and claiming a 100% deduction. Make sure you speak to an advisor to ensure that you're claiming your capital allowances correctly, or better still, you can get them to do it for you to ensure that you're getting the maximum deduction possible. Another great way to tax plan is to make smart pension contributions. Think of pension contributions as a little gift from the government when it comes to tax planning. Here's how they work for different tax bands and different types of taxpayers. For those who are basic rate taxpayers, you will be within the 20% income tax bracket. The government effectively tops up any contributions you make to your pension by 20%. For those who are higher rate and additional rate taxpayers, your pension contributions are even more valuable. Higher rate taxpayers receive 40% tax relief on their contributions, and additional rate taxpayers can receive up to 45% in some cases. This makes pension contributions particularly attractive for higher earners looking to reduce taxable income while also saving for your retirement. You can currently contribute up to £60,000 each tax year, or 100% of your earnings, whichever one is lower, to your pension and benefit from tax relief on those deductions. Another great thing to note when tax planning is the importance of timing and income expenses. The timing of your income and expenses is a strategic tool for tax planning, particularly for those who are self-employed or who own businesses. You can defer your income, so if you're expecting a higher income next year, but you're noticing that your income is slightly lower this year, consider delaying certain payments or bonuses until the following tax year in order to reduce your taxable income. You can also accelerate your expenses. If you're expecting to be in a higher tax bracket this year, accelerating expenses like repairs, equipment purchases, or other deductible expenses will help you to lower this year's taxable income. I know we've spoken about this before, and we honestly will continue to do so because ISAs or individual savings account are such a powerful way for anyone looking to save or invest without having to worry about the tax on interest, dividends, or capital gains. There are cash ISAs, which are tax-free savings accounts where any interest earned isn't taxed, making them ideal for risk-averse savers. You also have stock and shares ISAs, which are so ideal for those looking to invest, with any growth, interest, or dividends earned exempt from tax. There's also an annual allowance which allows you to save up to £20,000 each tax year into an ISA. Using this allowance annually is a smart way to protect wealth from tax over the long term. I would also recommend considering salary sacrifice for benefits. Salary sacrifice arrangements can be a win-win for both employees and employers. Here are how it works and the advantages of doing so. With a salary sacrifice, employees agree to sacrifice part of their pre-tax salary in exchange for benefits like increased pension contributions, cycle to work schemes, or even electric vehicle leasings. The sacrificed amount doesn't count as taxable income, which can reduce your income tax and national insurance contributions, leading to savings on both ends. For those who own companies, whether it's your own company that you own or whether it's a side gig and you're considering incorporating, a common question that I get asked working in tax and that I know is thrown around a lot is the difference between dividend payments versus paying yourself a salary as a business owner. It's important to understand the dividend payment system because this will help you so much in your tax planning. It's important to note that the dividend allowance has been reduced to £500 in this recent budget that we've just seen, and that there are potential discussions to seeing this being reduced even further to £250. Dividends are taxed at 8.75% above this for basic rate taxpayers and 33.75% for higher rate taxpayers. And for those of you who are fortunate enough to be additional tax rate payers, this will be at 39.35%. Paying yourself a combination of salary and dividends can really help you to minimise your national insurance contributions and your overall tax liability, but it's essential to work with a tax advisor to ensure that compliance is met in every aspect. We saw a big change in capital gains, and capital gains is a big consideration for those who are property owners, investors, or business owners looking to sell your assets. For individuals, the current tax-free allowance for capital gains is £6,000. Using this allowance strategically can help you to minimise your tax burden on the assets that you plan to sell. If possible, spread out asset sales over multiple tax years to utilise capital gains allowance each year rather than exceeding it in one single year. It's also important to note that there were capital gains changes announced in the budget. This includes the lower rate of capital gains tax increasing from 10% to 18% and the higher rate increasing from 20% to 24%. Capital gains rates under the Business Asset Disposal Relief and Investors Relief will gradually increase to 14% by the 6th of April 2025 and eventually reaching 18% by April 2026. There has been a lot of discussion around removing the capital gains tax-free uplift on death, meaning that unrealised gains could face capital gains tax before inheritance tax, potentially increasing the estate tax burden for beneficiaries. Please note that future plans may see capital gains rate brought closer to income tax rate, potentially raising them further for high income taxpayers. I'm a big believer that giving back is such an important thing to do, and the fact that charitable donations can be used for tax relief is such an added benefit and an added incentive to give back as much as possible. Charitable donations don't have to just support great causes, they can also be used to provide you with great tax benefits. If you're a UK taxpayer, Gift Aid allows charities to claim back 25p on every pound that you donate. Higher rate taxpayers can claim additional relief through their self-assessment. For those who want to make a larger impact, a donor-advised fund allows you to contribute, receive tax relief upfront, and to distribute funds to charities over time. One other thing that we should consider are the tax implications of inheritance planning. Inheritance tax planning is crucial for anyone with a substantial estate. Here are some great ways to minimise the inheritance tax burdens on your loved ones. You can gift up to £3,000 annually without it being added to your estate. Larger gifts may still be exempt from inheritance tax if you live for 7 years after making the gift. Trusts can also be used to set aside money for beneficiaries in a tax-efficient manner, as they are typically excluded from the estate for inheritance tax purposes after 7 years. While the budgetary changes definitely are going to be impacting everyone, I hope that today's tax planning and tax strategies episode has helped to shed some light on some of the ways that you can start planning regardless of your financial background and financial situation. From pensions to ISAs, deductions and capital gains planning, these tools are available to help you maximise your financial potential legally. Remember, tax planning isn't just for the wealthy, it's something that absolutely everyone can benefit from. So by starting to think of some of these strategies now, you can set yourself up for financial success in the future. Thank you so much for tuning into this episode, and I look forward to speaking to you all next week to help you achieve more tax-savvy financial wellness strategies. Until next time, bye.